Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host, joined by Brian London in New Orleans, Louisiana, and we are celebrating 200 episodes. I cannot believe it. So about 4 years have passed since we began this, and it's my honor to host these shows and to hear from so many amazing guests. We have Gary Alexander to join us for this historic episode, and he was editor of Gold Newsletter from 1983 to 89. And these days, he is a senior writer for 𝗵𝗫𝗫 and Associates. Gary, welcome to the show.
Well, thank you very much. Good to be here.
And before we started recording, you mentioned how you're not on Twitter and you avoid, I guess, a lot of the tech giants. What do you make of this transition now, though, to so much information going away from the paper or print era? How do you process this new era, looking back 40 years on? Almost 40 years on.
Well, of course, I don't want to sound like too much of a dinosaur, but with linotype, where you're able to read upside down and backwards hot lead coming out of a machine, and you've got to make it make sense and line up right with a college newspaper, and then with magazine type back in the late 60s. So that's how old it gets for me.
Yeah, and how did you get involved with Gold Newsletter? Were you a follower? Because we're actually celebrating, and Brian, correct me if I'm wrong on this, 50 years of Gold Newsletter this year, correct?
Yeah, we're trying to figure out, do the math exactly, and Gary's the best person to do that. But the first issue was published, I believe, in November of 1971. So we are I believe, are about to enter our 50th year of publication.
Right, and I did all the original research in this book that I wrote with Jim Blanchard in the summer of 1989, and I had access to all the original research at that point, and it was November of 71. And I was researching the gold market at that time in Southern California, and I was able to access all the hard money newsletters that existed at that time, which amounted to 3 or 4 of them. And that was because my father was a member of a gold-based investment club when he worked at Boeing Aircraft Company in Seattle, and I was studying economics in Southern California. So he would send me some of those gold-based newsletters, oily Xerox copies at first, and then I got my own subscriptions on paper from Harry Schultz, Jim Dines, and later on Howard Ruff. I'm sorry, the name escaped me. This happens at my age, by the way. and
probably
Vern Myers, and a few others.
Right.
Yeah, and to kind of set the stage here, you're looking at the history of the hard money movement, as it were, which actually, as Gary notes, began kind of in the 1960s as guns and butter. And government spending and more entitlement programs were being enacted, and people were kind of farsighted in seeing where all this ends and where it would end. And there were very few newsletters back then. Jim starting Gold Newsletter in 1971, and there's very few people left around today that know of that era, know of the importance of it, and the brilliant minds back then. I used to read all of these. And in fact, my first day of working for Jim Blanchard in 1985, Gary showed me around the offices and introduced me to everybody, including, I believe, Jim Blanchard in his office. And they used to keep, but Gary actually was a keeper of a filing system, a big piece of furniture. He had little small shelves and would keep the last year's worth of every newsletter out there. And there were about probably 40 or 50 at the time when I started in 1985. And as Gary says, in the 60s or so, only just maybe 4 or 5. But that was the way people communicated back then, these ideas and the philosophy of gold ownership, et cetera, because you couldn't recommend individual companies back then. It was an SEC violation. So you had to talk about the philosophy of hard money and the economy and things like that. But some of the writing back then, really a lot of it, because you had to be really good to be successful in the newsletter industry. It was just brilliant. I used to love to read those issues, and Gary was a real student of it at the time. And like I say, he is, I think, the best man alive to talk about that, to talk about the hard money, the history of this hard money movement and how it relates to today. I think there are a lot of similarities to today.
And right, before Brian came, we could not talk about gold stocks at all. There was a SEC violation, as you said. Then there was a decision, the Lowe decision was called in late 1985, whereby you could talk about stocks. And so we had to talk generically about gold up until late 1985. So what I would do is I would read the newsletters, and I have the files, as Brian said, but I'd also call up the newsletter editors like 𝗵𝗵𝗁 and the Jim Dines office and so forth. And I'd get their latest ideas, and I'd put them in paragraph form, and I'd say, this is what such and such says about gold and the others. And I'd have long form interviews with a lot of the people, experts about gold. And it was tough because when I got there in January of 1985, gold was pretty high, about $500. And then the first month I got there, gold headed down. So I've always had this dilemma of what do I say about gold when it's going down? And that's been a big, hard battle that Brian's had to fight in the 90s as well. And from 2011 to 2015, when gold's going down, what do you say? What are you going to do to keep the faith of the faithful? And gold has always come back, so it's never a problem long term, but short term sometimes it is a problem to keep the faith of the faithful when gold is going down in terms of the dollar. Because long term, in dollar terms, the dollar's only worth a penny of what it was a century ago and 2 cents of what it was worth 50 years ago, and so forth. So long term, it's a good, solid argument, but short term, you've sometimes got to be inventive.
Yeah, and nobody knows better than me and you, Gary, the downside of having a letter called Gold Newsletter in a gold bear market. It's really, if you could name it anything else,
Yeah.
you wouldn't. But it's so cyclical. These markets are so cyclical, and you're really a slave to it. The good thing today is that we can talk about stocks, and even in a bear market, there are stocks that do well, that can do well if they're picked. The timing and and you pick the right stocks, et cetera. But largely, it's very difficult to do. And these days, the broader information on the economy, the kind of things that the newsletters back then thrived on and were able to support a subscriber base on, a lot of that information is free, most of it. There's very few newsletters out there, which are all electronic now, of course, but there's very few out there that can support a subscriber base just talking generally about the markets. What people will pay for today are specific stock picks. And that seems to be you have to be somebody like Jim Grant to be able to support, a newsletter that muses about the economy and the markets rather than offers up specific ideas, investment ideas, which Jim does, but just not a lot of that.
And Jim Grant's a brilliant writer, and people buy him for his style. And there aren't that many stylists in the newsletter community because people generally want investment advice. And when you look at that, this is a free country, people say. But for 40 years, you could not buy gold in a free country, America, from 1934 to end of 1974. And then you couldn't talk about stocks in a free country. You couldn't name stocks in a newsletter in a country which is supposed to have freedom of the press. These are amazing things, and most Americans don't know that. You couldn't name a stock without risk of going to jail. In a gold newsletter, you couldn't name a gold stock until 1986. These are amazing things. Most Americans aren't aware of that.
Yeah, and a lot of those changes were due largely to the efforts of our great friend Jim Blanchard.
That's right.
And I think a lot about where he would be today. And what he would think of today's world. And in some cases, I think he would absolutely be in his element, not just because he would be railing against so much that's going on with the central banks, et cetera, debt creation and all the monetary forces at work, and the fact that gold is doing so well and precious metals are doing so well and entering what looks to be another long-term secular bull market. But just the freewheeling nature of information that he was such a fan of. He was such a voracious reader. He read every newsletter that came in the office. I know you would get the copies secondhand with all of his marks and notations and underlinings and everything else. And one of my prized possessions is Jim's desk copy of Confessions of a Gold Bug, with commentary and the margins, et cetera. He would do that sort of thing, and he just was a voracious consumer of information in words in a row. And I could just see him, if he would have learned to type, which would have been a big hurdle. I could have seen him, the emails that would come out from him to anybody and everybody, and the commentary that he would put out on social media. And me, as somebody who for many years was, and you as well, who were kind of charged with reining him in, we would have been totally helpless, I think.
I think
control, perhaps.
That was the secret to my success, and I think yours too. That Jim was an idea machine, and you and I were both capable of fulfilling his idea machine demands. Like, he would call me up and say, "Alex," that was my company name, I'd like some fact sheet on such and such. And 30 minutes to 60 minutes later, I'd get him a couple of pages of backup material, and he could write an article. And I'm sure you'd do the same thing. A lot of people would say, "Oh, gee, that would take me 3 or 4 days." No, we can do it pretty quickly. So he liked that, and that's why he kept us on.
Yeah, we were indispensable to him because he would dictate everything. And, the transferring the stream of consciousness talk that he would have into the microphone, and then it would go to a secretary who would transcribe it. And the secretary would very likely not know a lot of the specific terms. So it would be phonetic spellings and like. Many a late night, I was up trying to translate all of that into something that could be printed. And I know you had a special skill at that as well. I mean, we really were the brotherhood of interpreting Jim for the masses and trying to corral that, in a lot of cases, that great enthusiasm and genius in kind of folks at times. Man, I tell you, I think about what he would be doing in the junior mining share market today, and it would be buying up everything and anything. He would just have been a force to be reckoned with today.
Yep. And what do you think of the junior mining share market in this wild world of political unrest and all that? Because I think, I've always wondered, is there a generic conflict between the price of gold and gold mining? If we get too much more gold, will the price of gold go down if you have too many mining efforts? I mean, isn't there a generic conflict between mining and the price of gold?
The Gold Newsletter podcast is proudly sponsored by the Discovery Group of Exploration and Development Companies. To learn more about our exceptional track record and exciting future, visit discoverygroup.ca.
Hi, I'm Brian London, and I'm here at this week's CEO interview, wherein we interview the CEO of one of the Discovery Group of companies. The Discovery Group, of course, is the sponsor of the Gold Newsletter podcast. And this week, I have the pleasure of talking with my old friend and longtime friend as well, Jim Paterson, CEO of Valore Metals. That's the symbol VO on the Venture Exchange. Jim, great to have you back here.
That's great. A backhanded compliment to start things, Brian. I appreciate that.
It's too easy to give a direct compliment. I've got to have a little backhand in there. Jim, everything seems to be coming up roses, as it were, with Valore. We were anticipating the first drill program. You're well into phase 1 of that drill program. And the drill results seem to be confirming your beliefs, especially at the 𝗵𝗵𝘁𝗃 target, which you've been drilling so far, kind of confirming the geophysical targeting that you have. And can you talk to us a little bit about that established resource in this huge anomaly, this whale tail that comes off to the south of it that you're targeting right now?
Yeah, the results have been great. So we've released, at least we had 2 news releases last week and the week before, and those are the very first news releases we've put out, Valore's put out on this project, the Pedra Branca project. And so we tested 𝗵𝗵𝘁𝗃. We tested an area just around or fringing the resource where we had success. With the drill holes, we brought the mineralization right to surface. So we actually identified mineralization that came right to surface, which will be very helpful for us when we do an additional resource estimate in the future. We also drilled down dip, and we noted that the mineralization was thickening down dip and down plunge, which is a very good sign. Just that mineralization, that layer is getting thicker, which is obviously advantageous. And then we got lucky, we stepped to the south, and we hit in hole 13 a big broad interval of mineralization as well. So what you're referring to is there's a big geophysical anomaly that we identified when we actually reprocessed the geophysics. And so that was a target it was unknown to us. We had not drilled it, put a hole in there. It's the right unit and it's mineralized. So after we actually hit that, we were waiting until we got assays back before we really went after it, because we wanted to see if it was mineralized or not. We knew it was an ultramafic unit, but not if it was mineralized with PGEs. So we went off to the north and have been drilling the other targets as part of our 3,000 meter phase 1 program. And those target drilling, the drilling of those targets will most likely be complete within the next week or so. And so now that we've had the really good results from 𝗵𝗵𝘁𝗃, we'll come back to that area you're referring to and just start marching with the drill rig to the south on that big geophysical anomaly that extends for almost 1 kilometer to the south of the known portion of the resource. So the geophysics that you're referring to has really helped us in our targeting. And then, of course, the drilling confirmed that it's something of great interest to us.
Yeah, something obviously of great interest, that scale, about 1 kilometer long anomaly, and you've only gone about 140 meters along strike into that anomaly. So huge potential left, but I think it's important to set the stage again. I don't remember if I mentioned, but you're interesting in this major new gold and silver bull market in that you're largely a PGM play, platinum and palladium, plus some gold credits, but very palladium rich, especially in the 1 million ounce plus resource that you have on your project in Brazil. And what's important for people to realize is how many targets you have already identified, how many of them already have resources on them that are just right to expand, and that your drill program in progress right now is hitting 5 additional targets as well. And all of these are very high on the priority scale. They have something that tells you these are easy resources. This is the low-hanging fruit.
Yeah, across a very large land package, over 50 kilometers, there are 5 zones that make up the resource. And the ones in the north and the south have been less explored and less defined, but they're wide open for expansion. There is one in the middle of the property called 𝗵𝗶𝘁𝗃 that's been really well defined. And so we don't see that one as having a lot of potential to grow. It's been well drilled off. But it is something that has high grades and close to 400,000 ounces. So it's a nice little body there. The other ones, though, were completely wide open. And so a focus of both phase 1 and phase 2 is to do resource expansion. So, starting from what we know and moving to the unknown, drilling off these targets if they're geophysical anomalies or if we can follow a structure. And we're trying to build on that, build ounces. But we also have a lot of targets on the property that have been drilled, 1 or 2 holes, and they're a great geophysical anomaly or maybe a geochemical anomaly, and they have been drilled and they have PGM mineralization in them. So those ones will be drilling as well. A couple of well-placed holes there will give us indications if we can drill a bit more and pull those into the resource category. And then there's a few of them that are just exciting. Like there's one we're drilling as part of phase 1 called C4. That one was not in our database at all, but we used the geophysics the spectral analysis or the satellite imagery, prospecting. We came back with rock samples that ran almost a little over 7 grams platinum, and we're drilling that thing this week. So it's pretty exciting. It's gone from not knowing about it at all to drilling it as part of phase 1. It's pretty exciting, and I would say that we're on the edge of our seats.
Well, I am too, as a shareholder. Valore's been a recommendation in Gold Newsletter for a good while now. I'm a shareholder. I bought in the market after we recommended it. So I'm very happy to see what's been going on. But I think it's important to note, in the junior mining company, junior exploration company, an investor or shareholder wants to see news flow. So you've got lots of news flow coming up. But it's also important that that news be good, obviously. And what you're drilling right now are high confidence targets. I know you can't, in your position, can't speculate on whether you're going to hit or anything like that. But it's obvious that you're going after the targets where you're very confident that you're going to hit something, because there's been previous drilling close by. There's been previous drilling, identified resources with clear anomalies that haven't been followed up on. So that's the kind of story we're looking at right now. A company that's going to deliver very likely, definitely a lot of news, and very likely that a good bit of it is going to be very good.
Yeah, when you drill untested targets, you face the risk that you come back with a duster. That is absolutely a risk in any kind of drill program. And in fact, it's possible that you have the highest confidence target imaginable and you still don't hit. But in our case, we have a mixture there of very high confidence targets that we're looking to expand. Those are on the lower risk category. And we've got a couple that, all the ingredients are there, but we need to test it with the drill. And those are high confidence exploration targets, but we really won't know what we find until we drill it. But it is a very, very fertile system. There's PG mineralization over 70 kilometers of strike. Obviously known defined ore bodies, high grades, and the exploration potential is phenomenal. And we're starting with this 1 million ounce resource as a foundation, and it's something great to grow from.
Good point. 1 million ounce resource that, judging by your current market cap, seems to be not really undervalued, but not really valued at all, because you're valued more as an exploration play. I don't think the market's giving you any credit for over 1 million ounces of resource already. In terms of timing, I think it's opportune. You're delivering news. It should be pretty good news given the targets, but we're also in that period right now where the metals bull market has taken a bit of a pause. We're kind of consolidating the last rally, getting ready for the next move up. It all spells a window of opportunity to me for the junior mining sector in general. And for Valore, with lots of news on the way, almost immediately, it seems like a perfect opportunity. So, Jim, thank you so much again for giving us an update on Valore Metals, and a key member of the Discovery Group of companies. Thank you so much.
Thank you, Brian. Thanks for having me.
Not really. People bring up the supply-demand situation and that we've reached peak gold production, and perhaps we have, but really, gold bull markets and silver bull markets primarily monetary phenomenon. For instance, in silver, people look at the industrial usages of silver, and I think that is as useless as looking at jewelry demand for gold. It has no effect on the price, or very little effect. And what really drives the market powerfully in either direction is monetary demand. If things are fine, if people can perceive that things are fine, and they have great faith in their currency or currencies in general, then gold tends not to do very well, especially if there are other avenues for wealth creation, like a booming stock market. But when you do have monetary demand and powerful monetary demand for the metals, it wipes out every other consideration. Physical demand for gold and silver is plummeting in the East because there are bargain buyers. And that's usually a big support for the market and prevents huge downturns in the price. But in a monetary bull market, all that gets washed aside and by the investment demand for metals, and that's what we're seeing right now. And I look at the trends with money creation, debt creation, and they're not only continuing unabated, they're accelerating. So I think this is kind of a bull market that is going to last for years. And yes, it'll bring more supply to market. Higher prices always bring more supply. But in the end, I think the demand issues are going to overwhelm all of that.
And when you say monetary demand, is it more ETFs or is it more physical actual possession of gold coin and bar demand?
Really, both. ETF demand has been very important to the gold market, vitally important, I think. There are a lot of paper representations for the market. I think that COMEX and the futures markets are having some structural weaknesses exposed in this market. And in this kind of an environment, Western physical demand for metals accelerates, but that's limited by manufacturing capacities and the like. So the ETFs tend to, or have been more and more becoming an alternative to the futures markets for investors and for big investors.
Okay, I hope we're not going too far off point here, but the money you brought up, the trillions of dollars in new liquidity, it seems to be pushing every market up. We see lumber going up, a huge amount. We see silver, copper, gold. We see stocks going up, real estate in most markets going up. Is this just a factor of, we don't see consumer prices yet going up, but is this a matter of liquidity pushing most financial markets up right now?
Yeah, it is largely. When you have markets that are driven by liquidity factors, by all the central banks in the world trying to devalue their currencies at the same time, then all correlations go to one. We've seen this since 2008, except for that period when we did not see retail price inflation emerge after the Fed's efforts, and we saw the Fed about to begin and then begin trying to taper. At that time, we still had buoyant equity markets, but the metals went into a bear market. But when you have central banks driving so much liquidity and trying to create wealth effects through asset bubbles, then all correlations go to one. You don't get that kind of, I'd be interested to see how modern monetary theory has evolved over the last 15 years, because before 2008, you would have seen, a lot of a portfolio mix coming in to create an efficient frontier and the highest risk-adjusted return. But that's all backward looking. So before 2008, it was backward looking and not factoring in this period when all correlations went to one. And now, you're getting enough history that those portfolio mixes have to be changing pretty dramatically, I would think.
Yeah, that's what I was going to ask next, because modern monetary theory is now a fact. And in 2011, when gold first hit 1900, it came over an argument about a debt ceiling, which is now totally forgotten, and a downgrade of U.S. credit in August of 2011, which sent gold up about $400 an ounce over a 2-month period. And now there is no contest about debt going up $3 trillion in a 6-month period, and no debt ceiling at all. And gold has gone up to 2,000 and stayed there. And it could go up quite a bit more if there is continual rising of the debt to $30 trillion over the next year or so to the total aggregate. It seems like there's no thought of a debt ceiling or a limits anymore to debt growth.
No, and one of the things that I've been preaching over the last couple of years is that the debt is already so great that we can't have interest rates of any real consequence, and certainly not positive real interest rates of any consequence, because the cost of servicing that debt would crush the federal budget. I mean, if I've looked at history and looked at what's really the effective interest rate on the federal debt, And, people say you can't really calculate that because there's so many different maturities. It's a moving target. Well, I just went to the Fed data and divided debt by annual interest payments, on a quarterly basis. And as it turns out, that effective interest rate on the federal debt is actually somewhere between 2 and 4 points above the effective funds rate. So if we get to where the Fed wanted to get, say a 3% Fed funds rate back when it was tightening, we would have had an effective interest rate of 5 to 6% on the federal debt. That adds up to $1 trillion or more in just interest costs every year. And that to me would be politically impossible. Now with the debt growing so much larger, that hurdle rate of an effective interest rate falls and falls. And now it just seems to me that we're going to have negative real rates forever, unless there's some kind of a big monetary reset.
Yes, definitely negative real, but how about negative nominal rates? You think we'll go there?
Isn't it interesting, Fergus, how Gary has been our MC at the New Orleans conference for so many years, and he's so good at it.
I'm turning into an MC here. I'm supposed to be the MC, Fergus.
And it's a great question.
Yeah.
And I'd love to answer it because I have a chart in my presentations that shows the bottoms of interest rates during the Fed's many interest rate cut campaigns. And they cut rates after every economic hiccup post 1980. And it's just a stair step down. You see the bottoms are ever lower. The tops, when they try to normalize rates, never even get back to the midpoint of where they were before. So it's a stair step down to basically the foundation. And the next step is into the basement if you follow that trend. So they say they won't do it, but if you carefully parse everything the central bankers, everything Chairman Powell says, they never quite dismiss it absolutely out of hand.
That's right.
Yeah,
I'll turn this back over to Fergus.
No, I just wanted to add to that, Brian, that it is possible, but it would require regulatory control a little bit more, basically force people to park their money on negative returns. But Gary, right. I want you to hold up that book again, Confessions of a Gold Bug. This is a classic work, and I thought it was out in 1994. You said 1989?
Well, I wrote it in 1989, the summer of '89, with Jim. I spent 30 to 50 hours with him, often in his backyard, just interviewing him, plus all the records in his files. And it was between my working for him when I left in June of '89 and started work at Phillips Publishing in August of '89. So in 2 months, I did all the interviewing and writing. I'm a pretty fast writer.
Great. This is a classic work, and I remember I picked up a copy at the New Orleans Investment Conference a few years ago, and I just highly recommend people check this one out. I've got a review on it also available, which we'll put in the show notes. And Gary, Brian mentioned that the hard money or sound money movement originating in the 60s and the 70s, and how maybe that generation is passing on now. What would their message be to the next generation of people who want to, let's say, challenge the fiat currency regime?
Wow. It would be to, I don't know, get back to the basics of honest money. And one way to do that is to elect honest representatives in government. We had a very few back in those days, but not enough. Jim Blanchard worked with a handful of them. There were only 3 or 4 of them in those days. And we had Ron Paul for a long time. He's no longer in Congress. And there aren't that many you can work with now. So it would come from having electing honest politicians, and I can't point to any that I would know now that you have been able to work with.
Well, do you see parallels between that era and now with the rise of cryptocurrencies, or do you think cryptocurrencies are a distraction and a diversion from what we should be focusing on?
Well, I'm not an expert on cryptocurrencies, but I would say that the libertarian aspect of cryptocurrencies are a step in the right direction. I, of course, would favor gold over cryptocurrencies for the stability cryptocurrencies can go way up and way down, and they're subject to fraud. The 𝗵𝗁𝗀𝗃, I think it's called, it was a big fraud there in Japan. And there are risks involved with those, but I would favor gold in that. And Brian, do you have any comments on that? I don't follow that too closely.
Yeah, I look at cryptocurrencies at this point as an investment in a speculation like a tech stock, because I think it has they in general have great potential. Bitcoin in particular has great potential, but I don't think anyone has yet a very firm idea of how it'll play out and what the usages will be in everyday life, not just as currency. But, Gary, I'm curious to see what you think. You talk about what can be done today. I think if there were legislation that would that would establish gold and silver as legal currency, and that they can't be taxed. There's no tax burden on them, and they can be accepted as legal tender, but not required to be accepted as legal tender. And the dollar would not be replaced as legal tender. So what that would effectively do is, Gresham's law would take effect, and gold and silver would be withdrawn as currency, would not be used as currency, but they could still be used to protect citizens from the effects of fiat currency creation. So the Fed could still go out there and pull its levers, and all the other central banks could do the same. But in the US, they could pull the levers in the economy, create liquidity, play their games, but everyone would be protected from that and wouldn't have tax liabilities from their holdings. I think that in this environment would be much simpler to get accomplished, either through legislation or through the courts, because there's not that much tax revenue that would be lost because of that. And yet it makes sense, because after all, it is in the Constitution, and I understand all the legal arguments and de facto legal arguments against the gold being mentioned as currency, the only currency in the Constitution. But it is in the Constitution, and this would be a way to do it without disposing of the dollar and all the power that gives to the central banks. So, in other words, no constituencies really to argue against it.
Right. I feel there's some danger if Biden is elected that he would tax coin purchases, and he would tax capital gains on gold and silver coins and purchases as if they were, stocks. And coin as money, I believe, should not be taxed or taxed on capital gains, but that's a separate question.
Yeah, you're a little leery of that question, I believe, after your experiences.
Yeah, okay.
Well, Gary, let's say you're not so enamored with the rise of cryptocurrencies. Do you see some optimism in the rise of, let's say, the end the Fed movement and rising awareness, right? So particularly with the Ron Paul presidential campaigns, there was this groundswell of interest and awareness of the Federal Reserve and its predatory nature. And does that harken back to the 70s?
Well, I'll be a bit in the old school minority among hard money people here, and I think there is a role for a central bank. And I think they did prevent a lot of chaos in various points. I think they exacerbated the Great Depression, and they made a lot of mistakes over their now 107-year career. However, I think there is a role for a central bank, and can't have total laissez-faire in money. Now, is that going to make me an enemy of the libertarian school? I don't know.
Yes,
but there is a role for the central bank.
I saw a great tweet today by Zero Hedge, and again, Gary, you really need to get on Twitter. You would be fantastic on it. But Zero Hedge put out a tweet, and they showed a chart of financial crises. And I don't know how they defined it, but since the early 1800s or something, financial crises, and you see very few during a gold standard. But all of a sudden, after 1913, you see all these bars appearing, and some of them in wide bars, which means one crisis after another. And then you see the same thing after 1971. So I just look at that and I think, what a coincidence that those 2 years are ushered in many more financial crises, when in fact they were, I think events in those 2 years were designed to prevent them.
It's a close call, Brian. Would we have the prosperity we have now without the inflation of the money supply? It's a devil's argument, but would we have the prosperity we have now? I don't know.
Well, I'm actually not that far from your view in that when there are crises that maybe you need a central bank to provide liquidity. But if that was tied to gold in some way as a backing, then what you would have would be an upfront and, let's face it, devaluation of the currency, rather than this kind of stealth devaluation where nobody really knows what the value is of the currency and nothing to anchor it to. So, so there are certainly arguments on both sides. And, if there was completely a gold standard and the issuance of currency was limited, then I think at some point you couldn't mine enough gold, and perhaps the value of gold would go up to encourage more supplies, but it would be a governor of economic growth to some extent.
Certainly would be nice if we had a scientific experiment of a land without a central bank that had a gold standard somewhere that we could compare side by side, but we don't have it. Do we?
But would that work in a vacuum? Because then that country would benefit from its differences from all the other countries. So it would become a haven, perhaps, for capital.
Well, where would it be? Some island somewhere?
Our friends tried to buy an island from Vanuatu at one point in time. And
it would have to be a large economy somewhere.
Yeah. No, not really, because it could be just a banking economy, just a haven. I mean, the Caymans are not, they don't have a big industrial base or anything like that. But their economy largely exists because of the banking system and financial hub, being a financial hub. So yeah, it would be interesting.
Pretty late in the game.
Yeah. The game may be late enough that it would force this, actually.
Yes, could be.
And
I think it would be the game for a novelist to write. See how it would span out in a fantasy world, and then put it into practice.
Mm-hmm.
Gary, do you want to comment then as we wrap up on the changing role of financial newsletter writers? And Brian said before that in the past you could focus more on just macroeconomic observations, discussions, and now we're moving much more to the stock picking reality. Is that just much harder to deal with? And is this a healthy transition?
You're asking me?
Yes. Yeah.
Yes. Well, I feel that there is, of course, in the electronic world, there is a huge increase of written material. It's much more so than a newsletter, where you would wait anxiously for that newsletter to come in your mailbox, and you would devour every word of the 8 pages, and you would act upon it. Now we have electronic information, and the human mind and the backbone and everything about the human body is limited to a certain number of words that it can process. And so you go for the bottom line, which is the stock information and what you can do with it to make more money. So the philosophy is thrown by the wayside. People don't read as many books as they used to read. They don't read philosophy and background. They want to get to the bottom line and make money, and that's to their detriment. So they skip the foundational steps of why they're doing what they're doing. I don't believe people read books anymore, and somebody just wrote a book called The Case for Looting. A young woman wrote that, and she was amazed, and she made the case that in Minneapolis, they looted every store in this strip but the bookstore. And her reason for that was because everybody loved that bookstore, and they just didn't want to destroy it because they loved it. I say they don't want books, they don't care for books, they'll never read a book because they don't care about philosophy that backs it up. So yes, they're reading for the stock information with blinders on. And that's my basic idea about blogs and Twitter and everything else. The idea, if everybody has a blog and can only read 5 blogs, your average blog audience is 5. So yes, Brian, somebody can have an audience of 5,000, but that means a lot of others are going to have an audience of 2. So you really do have a meritocracy. And I love music. I would rather have a music blog than an economics blog. But if I did a blog, it would probably combine the two in some way. So I don't know how I would handle that at age 75. I don't necessarily want to start a new business. That's why one reason I'm not on Twitter and not writing a blog is, I'm just cruising down right now. I'm not cruising up speed. I'm not trying to start a new business. So, I'm reading a lot. I read 120 books every year since age 20, so I read books. That's what I do. And I make music, and I write about stock market and gold. It's basically what I do.
Yeah. So your concern is just that this overwhelming deluge of information is drowning out the fundamental
That's right.
content. Yeah.
Yeah, you got my message.
Okay, mate. Well,
diluting money, just like money creation dilutes the value of money, and dilution dilutes the value of information creation, dilutes the value of information.
Right. People get stock names, but they don't know why they're buying those stock names.
Right. So let me just get the website for you, Gary. I took my browser down, but yeah. So you're with 𝗵𝗫𝗁 and Associates, and
it's 𝗵𝗫𝗁.com, and you can get my columns, weekly columns at the archives on that website.
Yeah, 𝗵𝗫𝗁.com, and with the tag growth, you get the growth mail from Gary Alexander. We'll have that on the show notes page. If you're on SoundCloud, YouTube, anywhere, please, you'll find the links there. And I would love feedback on how we can proceed beyond these 200 episodes, how we can update it. We've been evolving the show over the years, and I'm very happy that we have video now. We can see Gary's beautiful face. Otherwise, thanks so much, Gary, for giving us your time and for sharing your wisdom after all these years. It's an honor for me to be a part of this tradition.
Thank you.